How are you, Tom?
Hi, Brendan. I'm well. How are you?
Good,
Good
thanks.
afternoon, everyone.
Yeah, hello to all of our clients and welcome. I can see that we've still got a few people who are just joining us now, so we might just wait a minute or so before we start this. And I appreciate that you're all bearing with us on this first time. I'm sure there won't be any issues, but
Can you see the
nonetheless,
first page just as a check? Is that
yeah,
the two logos on? We're good?
I can see that. Yeah,
Excellent.
hopefully everyone
That's
else.
a good start.
It is a good start. Okay, so we look like we've got most of the people on board now. So we might just get started, but a big welcome to everybody. As I said, this is the first webinar that we've conducted, but we're really excited by the prospect of being able to communicate with our clients through such a means. And obviously, a lot of you have been talking to us through the likes of Zoom and the like, and it's a different environment, but it's something that we've all adjusted to, which is really, really a good thing for us to be able to continue to communicate. And this, I think, is just another way for us to be able to keep you informed through webinars like this. And as our email initially said to you with the invite, that we're really excited to be able to talk to you and introduce you to the guys at Drummond Capital. All of you who are listening today are in the MDA service, which has been really exciting for us to be able to provide that service to our clients. And it was a long time in the making, and hopefully you'll see the value that that's provided, and Tom will talk you through that today. We feel as though this service is certainly something that's going to benefit you for the longer term. So I also wanted to really spend this time to give you an understanding of not only how the portfolio performed, but also give you a bit of a market outlook that Tom will talk about, and most importantly, how the portfolio is positioned to take advantage of what we think is going to happen in the future. We wanted to put a face to the name as well. We've obviously spoken to you all about Drummond Capital, and we've got Tom Schubert today, who is one of the managing directors of Drummond. To give you a bit of a profile of Tom and the company, they provide an active global investment solution to companies like Halcyon. And we decided as a group, after interviewing numerous asset consultants, to partner with Tom and the guys at Drummond for a number of reasons, none more so than the fact that their experience and expertise is second to none. They've got a great team behind them with institutional experience, and they've got basically the runs on the board. Also, too, their investment philosophy is very similar to what Halcyon's has always been, where in the first instance, we're focused on capital preservation for our clients. So we do not want to lose our clients' money, first and foremost. And then obviously looking for those opportunities where we can increase the value of the portfolio, whether it's via growth or whether it's via income. That's the process that we've always looked at, I've always used, and Tom and Drummond are very much along the same lines. So it was for these reasons that we decided to partner with them. And today we felt it was good to put a face to the name. You all know about Drummond Capital, but we thought that Tom coming on board could talk more about their philosophy, how they started, and then obviously, as I said earlier, how the performance of the portfolios have gone, and then how we position the portfolio. Tom, I'll stop talking. I think everyone wants to listen to you, not me.
No, all good. Thanks for the kind introduction, Brendan.
I'll hand it over to you.
There's a bit of a disclaimer. I'll get that out of the way quickly. I'll assume that you've all read that in good time. Thanks to Brendan, Stephen and Dan, I guess, for the opportunity to share our insights with you, the clients today. I know you've heard of us, but it is our first formal presentation and hopefully the start of a series of regular updates we can share with you. As you may have been aware, we've been engaged with the team for over 18 months now. And as Brendan mentioned, we've really got to understand the strong investment philosophy and beliefs of the business, as well as the long-standing client base. And we worked really closely with the team to design and implement an investment service that preserved this philosophy, but also, tries to enhance the outcomes, bringing our institutional investment management experience to each and every client. And the power of the MDA service and managed accounts enables that. The service has been running for almost 12 months, and it's been through quite an initiation. I'm sure you'd agree, with a bear market in that 12-month period. How we're really pleased to say it's delivered on its objectives, both preserving capital against the worst outcomes in March, through to generating strong performance through the subsequent recovery. Look, I'll provide a bit of insight about what happened in the portfolios and the performance, share our current market views, and then how this translates to the current asset allocation. There is a Q&A box at the bottom of the screen. If you do have questions, please type them in, and I'll do my best to answer them at the end of the session. So just before we kick off, I'll give you a quick overview of the team. This is the team, highly experienced and qualified. Global multi-asset investing is complex, and it requires a diverse range of skills. Across the team, we have portfolio management experience across equities, bonds, currency, and manager research. 5 of the 7 have all worked offshore in London, New York, and Hong Kong. 5 of the 7, including all of the investment team, are shareholders in the business, which is really important and creates strong alignment of interests with the outcomes of our investors, as well as also everyone is also invested in portfolios and strategies, similar to the ones that we co-manage with Halcyon. The investment team meet every morning at 9 o'clock to discuss markets and debate our asset allocation positioning, as well as discussing the ongoing manager research agenda. We have really well established proprietary systems and processes, and I'll show you some of those throughout the presentation. We follow these closely, and if we believe a change is required, we communicate with the Halcyon Investment Committee that same day. And this ensures timely implementation of the best ideas. And given the speed and complexity in global markets today, and as evidenced, with our activity in March, we think this is paramount. So our partnership with Halcyon expands their internal capability and resources and ensures, best practice investment management for all clients. So as we mentioned, we're approaching the first anniversary of the portfolios, and pleased to report strong performance across all the portfolios and all time periods. We pride ourselves on downside risk management. We hate losing money. And so it's really pleasing to preserve against the worst of the March sell-off. But importantly, we used the cash to buy attractive investments in March, and this set the portfolios up to perform strongly in the recovery. Versus the institutional peers. So when you say the moderate fund peers or balanced fund peers, there are thousands of funds and investment managers in Australia, and they're aggregated based on their relevant risk profile. So this is the sum of all of the average managers, including the industry super funds and the like. And so, it's a pretty fair benchmark, and we set out to try and beat the peers on average over time. And you can see across all time periods, the portfolios are between sort of 4 and 8% ahead over the time frame. And the other thing I think is really important is if you actually look at the portfolios since inception, they're all in positive territory, whereas all of the benchmarks are still in negative territory. And that highlights really how important it is to preserve capital against the worst of drawdowns, because that way you've got your capital base to participate in the recovery. You're not just making up previous losses, and we think that's really important. But the outperformance has been driven by 2 main factors: active or tactical asset allocation and manager selection. And I'll cover off on both of these briefly. So it's a little bit of a busy chart, but I'll try and explain. It's basically demonstrating the active asset allocation versus the blue line, which is the MSCI World Equity Index. Each portfolio has a neutral weight to growth assets such as equities, which aligns with your risk profile, and your advisor will be working out what the most suitable risk profile for you is. So this could be 50% in the case of the balanced portfolio, or 70% in the case of the growth portfolio. And we use tactical asset allocation to increase or decrease that weight by up to 10%, depending on whether we're positive or negative on the short-term outlook for markets. And this chart's really taking you through some of those changes. And I'll give you a brief overview of the activity. Admittedly, there's more activity in the last 12 months than you'd probably see in a normal year, but it's been far from a normal year. So when we started the portfolios back here in November, we just sort of come through the phase 1 of the US-China trade deal. And so we call it a trade truce. We were seeing global manufacturing growth rebound as a result. We'd seen Boris Johnson elected in the UK, which was sort of reducing the risk of a hard Brexit. Central banks were easing policy, and the sum of all of that left us quite positive on the outlook for equity markets late last year. And so we were overweight. So in the case of the 50, that means sort of up near 58%, or the 70 up near 78% in gross assets. And that looked really good as markets rallied on into the new year. And as we were sitting there back at work in January, watching this little COVID or coronavirus, as it was called, unfold in Wuhan in China, we started to get a little bit concerned about what that could mean. And interestingly, it broke out in China first, and we were able to see the impact of the lockdowns in China on growth and activity in China and Asian economic data, which I'll show you a little bit later on. And it gave us an idea of the severity of the slowdown that would take place should such similar measures sort of be rolled out around the world, and should the virus escape China, for that matter. We sort of anticipated that the rest of the world would follow the Chinese path, if that makes sense. So we watched quite closely, and initially, as you remember, the virus was contained. We started to get worried. There were signs of it in Hong Kong and East Asia, and so we knew it was out of China, and we reduced some of that exposure in early February on the 12th. And then on the 25th, we'd seen it emerge in northern Italy and Iran, and quite clearly it was starting to spread. So we reduced exposure again. And the markets really started to fall on the back of that, because clearly it was out. And we're starting to see lockdowns emerge through this time. Then in March, the US Federal Reserve gave us a gift, in our view, which was they pumped in some stimulus to the system, and markets got a bit excited that would be enough to save the day. And you can see they sort of bounced. We used that as a really good opportunity to cut risk as aggressively as we could within the mandates, and really reduced our exposure to be underweight and conservatively positioned, which was good given the severity and speed of the decline. One of the fastest bear markets in history ensued. And look, top to bottom, equities were down 35%, which in our view was pricing in a lot of the bad news. And so in the back half of March, we had a lot of cash in portfolios, and we used that as an opportunity to be rebalancing back towards that neutral growth allocation, and start sort of looking to participate. There were things happening as well. Governments were obviously starting to step in and support markets. The Federal Reserve had bought a lot of assets, a lot more quantitative easing. So things to give us some pause for optimism, if that makes sense. The other thing that happened is the Australian dollar fell a long, long way during this time. It got down to almost 55 cents on the lows in March. And so we used that as an opportunity to lock in some of the gains from the fall in the currency. And then in April, we started adding credit or corporate debt. Again, these instruments were quite, they were a bit expensive in our view, and we didn't hold a lot of leading into this period, but they got incredibly sold down during March, and it was one of the areas that the central banks had supported. And so we used that as an opportunity to add that to the portfolio. And look, the sum of all that activity meant that, having preserved the capital through the drawdown, portfolios were able to participate in what turned out to be the swiftest recovery in history after the swiftest bear market in history, and really left us in a good position. Yeah, Brendan. Sorry
to interrupt, Tom. Could I just for the client's understanding, could you just talk a little bit about what corporate debt represents?
Sure. So it's a bit of a terminology issue. So on the defensive side of the balance sheet, we've got cash, government bonds, and then you're lending money essentially to governments, and then you've also got corporate bonds or corporate debt, also known as credit, and essentially you're lending money to corporations, and you sort of, depending on how risky the corporation is, you get paid a bigger and bigger margin above the rate that you would lend to the government at. So if you're lending to Woolworths, obviously the margin will be low. Whereas if you're lending to an oil and gas driller, then you would expect to be paid a lot for that loan, because it's a lot riskier. And so there's different parts of that market. It's no different than you going to the bank. The riskier your own debt profile, the more you're likely to pay. Does that sort of make sense? And so having participated in this rally really significantly all the way, At the start of September, we did take a little bit of exposure out of North American equities, and I'll talk to this a little bit more as we go back, partly related to valuation and partly related to the US election and concerns we have around that. So there's a bit of a sum of the activity at an active asset class perspective. The other area...
So Tom, just on that slide, so that's contributed, making those changes at those particular points has contributed to the overperformance compared to the peers?
That's right, yeah. So it's about 50-50. So when you look at the 4 to 8% sort of excess return, approximately half has come from the active asset allocation, so getting this call right, and then the other half has actually come from choosing managers which then can beat those benchmarks as well. So there's 2 parts to the process.
So it highlights the value of being able to act swiftly through the MDA service effectively.
Absolutely. Yeah, look, the speed at which markets now move, we've all experienced firsthand this year, and there's some reasons behind that as well around market structure and dynamics. They've changed now, and speed, I think just in the information age, information moves so quickly that it's priced into markets very quickly. And so you need to be able to, 1, have the information at your fingertips quickly, and 2, be able to act on it quickly. And otherwise, you've missed the opportunities. So it does help.
Thanks, Tom.
So this chart shows the performance of our active global managers versus the market in purple. So this purple line is the Vanguard International Shares Index Fund, which you've owned and may own over time. So we don't think there's anything wrong with the index, but that is just the aggregate performance of all the global companies listed around the world. And then these are managers which are cherry picking their best ideas from that pool of total market, if that makes sense. And they've different managers have different styles and different focuses. And so this orange line here is we added back in April, May this year is Fairlight. They're a global small mid-cap manager. So they're investing sort of in the next type of growth companies that you might find around the world. And then at the top here, really pleasingly, is Hyperion Global Growth Companies and Munro Concentrated Global Growth. And you can see over the time period since the portfolio started, I mean, these funds are up north of 30%, where the market is still actually down 2%. So you can appreciate how much difference that makes to the portfolio. And the COVID recession was, I said before, kind of one of the deepest on record, but also one of the shortest, and so too the equity market downturn and recovery. It's also been really biased in terms of who and what has been affected. So shutdowns clearly have impacted small businesses more than large businesses. And it's also accelerated, some large trends such as e-commerce, where we're all shopping and buying more online and working from home. And Munro and Hyperion, they're global growth focused managers, and they are looking to buy those types of companies. So they've owned Microsoft and Amazon, large beneficiaries of this environment. We undertake over 200 manager meetings a year, trying to find the best 15 or 20 ideas for each portfolio. And we're also looking for managers or strategies which are not necessarily in the mainstream yet, as often they're best generated to sort of, or best positioned to generate kind of these exceptional outcomes. When they're a little bit smaller and a little more nimble, they're focused on performance rather than having being out there marketing and running the business of being a fund manager, as opposed to just being a fund manager and generating performance. So we're trying to capture them at that sweet spot, and always looking for that next winner. And Munro and Hyperion and Fairlight to that degree sort of fit that manner. They're established managers, they're good businesses, lots of really good people. They're focused on performance, not focused on being big, I guess, and that's really important to us. Now we'll start going a little bit more into the outlook. We'll start with the long term. So this chart is taken from our 2020 strategic asset allocation review. So each year we produce long-term forecasts of returns for all asset classes. It's a really extensive process. The one thing about forecasts is they'll be wrong. And so what we try and do is think about the potential range of outcomes using scenario analysis. We have 3 main scenarios we think about in the future, particularly as it relates to the recovery here. What we call our return to normal, and that's really just the post-GFC environment where you've got reasonably sluggish economic growth. Like, we're growing, but at a much slower pace than history, and with it, low inflation and low interest rates. And that has been, generally, it's been a pretty good market for equities, and environment for equities, but particularly those sort of growth style companies where people are prepared to pay a premium for a company that can grow in a low economic growth environment. So that's the sort of return to normal scenario, and potentially, there's reasons to believe it persists here. And then we've got what we call as everyone is Japan. Japan has been marred since the end of its sort of, it had its big economic boom through the 70s and 80s, and then really it's collapse. And post the collapse, they've had deflationary pressure, so prices falling, subdued returns from asset classes, and really the aging population catching up with them. They're one of the few countries in the world where their population is actually declining. And if you look at some of those trends, well, we see a little bit of that emerging in Europe, and we see a little bit of that emerging in parts of Asia. And so there's a risk that sort of this recession, timed with the aging population, sort of sends us all down that path of everyone is Japan, and it has implications for how asset classes will perform over time. So we think about that as one potential scenario or risk. And then we have the higher inflation scenario. So this is where we go back to potentially more like the 60s or 70s, where we had economic volatility as we do now, but we had lots of fiscal stimulus. And we're seeing quite a bit of that at the moment, and I'll talk a little bit more about it. But lots of fiscal stimulus and lots of cheap and easy, abundant money, potentially leading to higher inflation down the line. And we think the US election and politics potentially has something to do with the path in which we move forward on. And again, I'll discuss that a little bit as we go on. But I think the important point to note here, under all scenarios, equities are sort of the best house on the street. Clearly, they're going to outperform the very low returns of cash and bonds. No matter which way we cut it, we're starting at basically zero interest rates and government bond yields less than 1%. The yield on defensive asset classes is very low. And so the heavy lifting in portfolios is going to come from growth assets such as equities. And it's why we think it's even more important to have a sort of active asset allocation strategy. Like, if you're more dependent on the return coming from the riskier part of the market, you want to have a risk management strategy that goes around that, because the defensive part is not going to be there to save the day like it has been historically. And we think that's really important. So this is our proprietary global growth barometer. You may have seen this chart in some updates that were written earlier in the year. It contains over 140 macroeconomic data inputs across all the major regions. So we look at the US, Europe, Asia, and Australia. It updates every morning at 8 o'clock, and it provides us real-time insights into global growth. Zero is basically just, across here is the average growth rate. So above the line is good. Above the line and rising is good, and below the line and falling is bad, in simple terms. And we can see here the rate of decline in growth was twice the rate of decline experienced during the GFC. So you can appreciate the severity of the recession that occurred this year. The other point is you can also see the rate of recovery was really, really sharp as economies reopened. And now we're starting to see that moderate. Importantly for us, and I spoke about this a little bit earlier, as you can see in Asia, the V down occurring before the V down in the rest of the world. And this gave us good insight and reason to reduce risk early, but also the really sharp recovery in Asia. Again, when things look pretty bad through March, April, May, we could see this acceleration in growth in Asia and gave us confidence to sort of persist with that recovery in markets. And really now they're sort of coming back to more moderate levels of growth. So growth is okay, but it is dependent on continued policy support from governments and central banks, and eventually the end of COVID-19, really to bring about normality in the recovery. So one of the reasons the recovery has been so swift is the record stimulus that central banks and governments have provided. Policymakers learnt their lesson from the GFC, and they went hard and went early. And this has been really positive for equity markets this year, and we think will continue to be so. You don't want to fight this level of support. It does present a risk if policymakers become complacent and withdraw too early. A little bit like what we're seeing in the US at the moment. There's a stalemate over the extension of effectively their JobKeeper package and other stimulus measures that have been dragging on at the moment because they're in an election year. And that is a bit of a cause for caution in terms of near-term growth. But just to give you a bit of an idea of the size of the stimulus, the left-hand chart is the balance sheet of the US central bank, the Federal Reserve. And the blue line is the sort of, you can think of it almost as money supply. It's the excess stimulus they're providing to the system. So quantitative easing, QE1, 2, 3. So you can see in the GFC, they took their balance sheet from 1 trillion to 2 trillion as part of the first stimulus. To give you an idea of how big the stimulus was this time, they went from sort of 2.5 trillion to 4.5 trillion in the space of a couple of months. Look, this is huge, and it's not to be underestimated. And you combine that with record low government bond yields, which is essentially the risk-free rate of interest, and you can see how that's really supportive for the outlook and growth. The big difference, though, this time versus the GFC is that in the GFC, we did see some fiscal stimulus coming out, and the light green bar here is the amount of stimulus that was provided coming out of the GFC, but it was slow and it was lumpy in some places. Whereas the dark green bar is the fiscal stimulus provided in 2020. And this is a percentage of the economy, or GDP. So in the US, they've provided north of 12% of GDP of fiscal stimulus, so more than double what was provided in 2008-9. And this is pretty consistent across the world. Australia's not on this chart, sorry, but it's of a similar vein. We saw Frydenberg's budget recently at $200 billion deficit this year is 15% of GDP. So big numbers. And that's not to be underestimated. When you combine low interest rates with lots of government support, that's very supportive for future growth. We do, however, need to get through, the health crisis, if you will. COVID-19 continues to be a problem as we head into the Northern Hemisphere winter with no vaccine. We are seeing accelerating case growth in Europe and continued growth basically in the US, which never really stopped, to be honest. The difference this time is that death rates and hospitalisation rates aren't anywhere near as high as the first wave, and that's a positive. So this top bar is just the case changes. So you can see the first and second wave, and the bottom bar here is the deaths change essentially. And so you can see it hasn't picked up as much as they saw in the first wave. So we have learnt about how to better treat patients on the virus. Also, obviously the most vulnerable potentially in aged care have sort of already experienced it. And we do have some treatments and therapies despite not having a vaccine. And Europe is a similar case. You can see a much bigger second wave, but not the same uptick in the death rate. So that's a positive. And this is resulting in less punitive measures or lockdown measures in the rest of the world, bar Victoria. So the rest of the world, I think they're basically, I think the pubs close at 10 o'clock instead of midnight in the UK now. And Wales has gone in, and there are parts of the country that have gone into lockdown, but they still have a much higher level of activity than what we experience at the moment. And it's focused on, as I mentioned, high-risk activity such as indoor dining and travel. But if the next few months emerge without a vaccine and it continues to grow, there is a bit of a risk of going further into lockdown in the US and in Europe, and it's something that we're watching closely. We've got a really large dashboard of data and indicators. The COVID one we showed you before, the growth barometer as well. One of the things we built this year was mobility tracking, so trying to gauge real-time economic activity using the data from your mobile phone. So I'm not sure if many of you or all of you are aware, but Google and Apple track using your mobile phone your movements around the economy. And that data is available as a very large database which you can access. And so we built a chart pack, which basically we can look at all the countries around the world across different sectors and see the level of activity. And this is quite helpful for getting a read on what's going on and how the recovery is taking shape. So the zero is sort of baseline of activity, level of activity pre-COVID. And you can see things like workplaces in Australia are still 20% below baseline activity. You can see this in many countries around the world. Transit or transport, in some in Australia is over 40% below where it was at the time. So yes, we've seen a sharp recovery, but we're nowhere near back to the levels of activity that we saw last year. So that's important to note. And look, there are some nuances in here, like the substitutes between sort of retail and recreation, obviously dining in and food delivery, and bricks and mortar retail versus Amazon. I've worked out how much my doorbell rings with home deliveries now. Being at home all the time, it rings all the time. Those trends have really accelerated through the crisis. So unlike normal recessions, kind of clear winners and losers. Then we got the US election. We put together a more detailed note on this recently, as we believe this election sort of holds more importance than it usually would, and also because the US electoral system is very different to ours. At the moment, Biden...
Sorry to interrupt, Tom. One of the questions from our clients is, I think around this, was asking about what change there might be with if Biden was to win. So if you could cover off that as part of this as well, that'd be great.
Absolutely. Yep. So at the moment, the polls are more than 10% ahead for Biden, and the betting is of a similar vein. So the markets and the expectation is that you're going to get Joe Biden in the White House, but I think now the expectation is for what we're calling a blue sweep, a Democratic sweep, where not only does Biden win the presidency, they also win back the Senate. They've already got control of the House. And so that sounds good. There's big implications of that. But if you look at the polls, I think the few things to note. Firstly, Trump won the 2016 election without winning the majority popular vote. And so the polls may be correct, and Biden maybe wins the House. But if the Republicans may retain the Senate, that's a big negative, because if you go back to Obama's final term, he had the presidency, but the Republicans had the Senate, and it was a real stalemate. So at the moment, they're disagreeing on extending fiscal stimulus, and that's negative for growth. And so if we see a case where the Republicans retain the Senate, then we think we're going to have a bit of a stalemate in Washington, and that's going to be sort of near-term negative for growth. I would also just be a bit cautious around the polls. Like, we're not going to hang our hats on and try and on the polls by any means, I guess, because it's a great way to blow yourself up and be proven wrong. We'd like to see the outcome. There's some really key states which Trump could still swing late in the picture here and potentially still retain the presidency. So it's sort of a bit too hard to know what that means. But there are big investment implications here, and sort of the equity market rally to this point, and we showed you the performance of those growth managers versus the broader market. You could see the really substantial outperformance, and it's really been led by a handful of stocks, those big technology names that I spoke about. And they've really benefited in this environment of low economic growth and low interest rates. But if Biden wins a clean sweep, we expect policy to change, where there's a lot of spending measures that they're bringing in place. So more infrastructure spending, climate-focused infrastructure spending, so clean energy spending, healthcare, as well as a big just near-term stimulus package to help those that don't have a job. That's going to stimulate economic growth and really fire up the parts of the economy and the market that haven't really performed, like banks and builders and energy companies and resource companies, like cyclically orientated businesses that benefit as growth accelerates, and will probably be to the detriment of those businesses and the stocks, like the technology stocks, that have really been the big winners in the short term from COVID. So we think there's a risk of a change of leadership in the market around what's worked for the last year may not be what works for the next year. And so one of the things we have been doing, as we spoke about a little earlier, in September, we did sell Hyperion. We reduced those concentrated growth managers, and we have been increasing cash. We raised a little more cash recently just from selling down some of the corporate debt again, which has performed well. And we're building up cash reserves looking for opportunity. We think The other issue is that Trump may contest the election in the Supreme Court, and that could bring about some volatility. And I'll talk about sort of valuations in a minute, but markets are priced for a reasonably benign outcome here, like a Democratic blue sweep, Biden in, no contested election. And we just feel that we need to be a little bit more cautious about the potential range of outcomes and also what's likely to work in the future. So we've sort of taken a little bit of risk off the table, being cautious, and then waiting to see what the outcome will be before redeploying that cash into the areas that we think are going to work for the long term. And that's really important. And just speak a little about valuation. So the chart on the left is showing the price to earnings ratio. So this is price divided by the next year's earnings for the market. And it's just an indication of the valuation of the market. And the blue line is the average valuation, the median valuation over the last 30 years. And then the pink dot is the current valuation. And you can see that most markets, but in particular Australia and the US, their valuations are quite elevated versus history. So they're not cheap in absolute terms, but you can't consider valuations in isolation. They're versus interest rates, which have during the 30 years of history have been much higher, versus interest rates today, which are very low. We don't think the valuation's as stretched as what it appears at first glance. And the other thing to note is that markets are forward-looking, and at the beginning of an economic recovery, which is sort of where we are, earnings are suppressed. You've had a big fall in earnings, and so that makes the valuation look a little bit more expensive. You can see this chart on the right. We're seeing earnings are starting to bottom out, and in some cases tick up. And as earnings grow, the valuation will fall. So the stocks will grow into that overvaluation. So it's sort of consistent with where we are in the cycle, both from an interest rate perspective, but also an earnings perspective. But the point to note is they're also not cheap. So if things could go wrong, we need to be mindful of that.
Tom, is that exaggerated with the tech side of the economy? So we're seeing really extended valuations, but the company's forward earnings is expecting to grow into those valuations. Is that your view on that sector?
Certainly. So we spoke a little bit about what's worked and what hasn't worked. So if you look at the US market has a much higher allocation. Microsoft, Amazon, Facebook, Google are all listed in the US. And so if you look at the valuation of those stocks, they're up in the 30s, so they're really high. But they're growing really fast, and people are prepared to pay more for that faster growth. And that's pushing up the overall valuation of the US equity market. If you look at other markets such as, UK, more cyclical, doesn't have tech names, it's got more mining stocks, it's got more industrial names, more banks. Emerging markets, similarly, far more geared to that sort of higher economic growth, manufacturing, etc. They're trading at much cheaper valuations. And this is part of that story we think about. If you do get the blue sweep and the growth profile changes, then some of that money may come out of that sort of more expensive, more defensive part of the US market and into the more cyclical and cheaper part of global markets. And we're just watching for that at the moment because they're quite extreme in terms of the deviations between the two at the moment. Does that make sense? So here's the portfolios. So the HIT portfolio is not on here, but it has the same risk profile as the moderate portfolio. It just excludes Australian equities. Go back one. So the Halcyon team work with each of you to determine your goals and objectives and the appropriate level of risk. And then we work with Halcyon to build the best risk return portfolio within each one of those risk profiles. And these are the current asset allocation. And this captures the long-term return expectations derived using that scenario analysis we discussed earlier. So you can see, and the reason to have a look at this is to sort of understand what the long-term risk return profile of these portfolios are. If we talk about the balanced portfolio, it's got a neutral growth range of 50%, as we said, and can be 40 or 60. That's the plus or minus 10, depending on the tactical views. And it's got an expected return of 5.4%. That's over a 10-year horizon. And that is just from the baseline of those asset classes. So we'd expect through the tactical asset allocation and the manager selection to add at least 1 to 2% a year above that. We've done a bit more this year, but it has been an exceptional year in terms of volatility and opportunity. But it gives you a bit of a baseline from, returns in the future, given a high starting valuation and low interest rates, are probably going to be a bit lower than what you've experienced over the last 30 years, where these numbers are sort of being closer to the high single digits than the mid single digits. And that's just indicative of the environment. Just
one thing for our clients, Tom, where you see the moderate portfolio, we actually call that the conservative portfolio. So if you're wondering where yours is,
sorry,
yeah, that's fine. Just to clarify for clients, yeah.
Thank you. And then this chart is just looking to show the, you might have seen this over time, but it's basically just showing you that there's active asset allocation or tactical tilts that we have in the portfolio. So we mentioned we're a little bit cautious and we went underweight. We showed that on the chart in September. And so across the board, you can see, portfolios are about 2% under their neutral growth target across the board. We can also see a lot of that is driven by an underweight to real estate. We think one of the real structurally impaired sectors is commercial property. None of us are in offices. They're sitting vacant around cities in the world. Even those that have reopened, there's still huge vacancy. That's going to take time to wash through the system and work out what the new normal is going to look like. And that's going to pressure rents. It's going to pressure valuations. Similarly, commercial retail shopping centres and how long it's going to take them to get back to full occupancy capacity. So we think there's some real challenges for parts of the commercial real estate market. So we're holding a more cautious allocation to that for some time until those issues work through and we get a clearer picture. We mentioned, government bonds have been really strong performers through the crisis, but have got down to a level now where the yields are sort of less than 1%. And so we don't think the risk reward for holding those assets is as strong. So we're holding a lower exposure to government bonds. And instead, we've sort of used that to build up some extra cash, which you can see here. So overweight to neutral cash allocations are sort of 7, 8, 9% across the portfolios. And that's not, cash is not going to pay us much in the short term, but this is not it's not a long-term hold. It's a short-term hold. We've built that cash up in the portfolios, one, to give us some buffer against unusual outcomes or unexpected outcomes that may result of the US election, two, to observe what happens there, and then seek to redeploy it in the areas that we think can best perform over the long term. So it's just it's a shorter term positioning that we're trying to manage around. That's kind of it, a bit of a summary. So the recession's been one of the deepest but also shortest in history, and a very different kind of recession, clear winners and losers. It's accelerated trends such as e-commerce and flexible working arrangements, whilst unfortunately bringing a rapid end to many small businesses. But they're not listed on the stock market, and that's been one of the key understandings, is the large cap businesses that are. Equities remain expensive on a PE basis, as we showed, but they often do early in the recovery, and versus interest rates remain very attractive. Record fiscal and monetary stimulus may generate some inflation down the road, but for now, our base case of low or disinflationary environment remains. Portfolios are slightly underweight growth, driven by the real estate exposure. And we're watching really this second or third COVID wave and also the outcome of the US election to decide on how to redeploy that cash.
So Tom, one of the questions as part of you deciding how you invest the money is whether there are any ethical considerations when you're making those decisions. Could you touch a little bit on that for us?
Absolutely. That's a really good question. So ESG, as it's sort of referred to, is environmental, social and governance. And they're three big considerations which all investors need to make, and there's growing importance around those considerations now. When we look at the G, so governance, generally all good managers that we are looking at are engaged with the companies in which they own or invest in, and good governance is makes a good investment. So I think that's something that's generally been done well by the investment community for a long time. If you're a good manager, you've got to find good governance in the companies that you invest in. The social aspect has been growing. So the sort of modern slavery, Woolworths mass underpayment of staff and the like is really getting, so it started with, ethical supply chains, making sure you're not having child slave labour in your supply chain, even now to modern slavery, making sure all workforces are being properly paid. And through technology and engagement, we're starting to see that being reported by all companies as part of their good governance, essentially. And then the big one really, I think that's growing in importance and reporting is the environmental piece. So the impacts of climate change on companies, their engagement with, understanding their carbon intensity, what the level of carbon intensity is part of the business. So you see a lot of large corporates now trying to become carbon neutral through positive investments in solar farms or wind farms to offset their energy use. We're seeing disinvestment of dirty coal projects and businesses. And so there's clearly winds of change. The challenge or the opportunity is from our perspective is the reporting on this is still evolving. It's quite new. And so we use two quantitative systems. We get a lot of great data out of the systems that we use to judge essentially the ESG rating of the underlying funds that we invest in. And we're also positively engaged with the managers. So we ask, there are a number of things the underlying fund managers can do. So, and pleasingly, I think almost all of them are some way along this path, and we can take you through the specifics, but they can sign up to the UNPRI, the Principles for Responsible Investment, and that's got a certain level of standards they need to adhere to in terms of their ESG considerations. We have a number of managers in the portfolio, Hyperion, that I mentioned before, Fairlight, etc., that actually report the carbon intensity of their portfolio. So essentially grams of carbon dioxide versus the benchmark, if you will. And we see that as a real positive trend. So managers actually recognising for each dollar of capital that's being invested in their portfolio, what's the actual environmental impact. So it's evolving. We're engaged with all the funds that we research and invest with positively on that front, and we will do more on the reporting front in relation to this as the data improves. We think we're getting there, but we're still trying to integrate all the systems, not because we don't have the data, but because there's not standardization yet across the industry as to what it is. We're still putting that all together, but it's an active process for us.
Thanks, Tom. We are getting some great questions, so we might just work our way quickly through these.
I might stop. Do you want me to stop sharing? Any of them relate to the slides? Would you like me to stop sharing the screen, or would you?
That's fine. You can leave that there. Whatever.
Yep,
you can bring it back to the front screen if you like. But
no problem.
One of the things, and I was interested to see what your thoughts were around the interest rates, and obviously everyone's interested in where interest rates are going. For our clients who have mortgages, they're more than happy with how the direction in which they're heading. But on the flip side of that is our clients who are retired, and unfortunately, they probably went through a period of high interest rates during times they had a mortgage. Now they're in retirement, they're suffering from low interest rates. Do you have a view as to which direction you think they're going to head? And that obviously then, which will answer one of the questions here, is around when will term deposit rates increase?
So last week the Reserve, we'll talk about Australia sort of as it relates to the world. Globally, and so if you go to Europe, interest rates went to zero and have not got off the floor for almost 10 years. So they're in fact in negative territory in Europe. Japan has been there now for 20 years. So that's sort of, you can see what happens when you hit this everyone is Japan sort of low growth, low inflation environment. Interest rates can stay here for a very long time. Australia's been late to the low interest rate party. I wouldn't call it a party. It's an unfortunate situation to get yourself into. But we've got now post this recession, we've got lots of unemployment around the world. We call that an output gap. It takes time for all those jobs to be rehired really before we start to see wage growth and with it inflation. And so central banks are going to be pretty keen to keep interest rates here very, very low. Last week, the RBA made noise. It looks like I think they're going to cut rates again probably as soon as the Melbourne Cup meeting. So going from 0.25 to 0.1, they can't really go much lower than that. That is as low as they almost go. They could go to zero, but it's a technical factor. The system's not set up for a zero in the zero number or negative number. It's quite a problem actually for the software and systems as they discovered in Europe. So we think it'll stay at sort of 0.1 and stay there for the foreseeable future until we see a proper recovery in the economy and that unemployment rate come back down. The RBA is also providing a lot of additional support to the banking system to help it through COVID. There's been a real cooperation between government, the regulator, and the banks this time round, and people sort of extending their mortgages or debt repayments, giving them a holiday. And as part of that policy support, the RBA will basically lend to the banks as much money as they need for 3 years at 0.25%. That's generally the rate at which the banks set the mortgage rate. And so by creating abundant liquidity at the 3-year rate, it's really forcing down mortgage rates, which we're now seeing under 2% coming around the place from various institutions. So we expect that to keep falling. What that means, normally the banks would be competing with each other for deposits to help fund those mortgages. And you would be getting, an attractive term deposit rate. But if the bank can go and get unlimited money on a 3-year basis from the Reserve Bank at 0.25, it's unlikely they're going to pay up the term deposits at these levels. So that's going to force down, unfortunately for deposit, for retirees, going to force down term deposit rates continually, we think, over the next year. But it keeps mortgage rates low, and that's a positive for borrowers.
Yeah.
What can change that is everyone thinks now that interest rates will stay low forever. There's a sort of consensus that we're going to have low interest rates forever. We've all become conditioned to low rates. And certainly the governments are going to hope, given how much money they're borrowing, that interest rates stay so low because they're the biggest borrowers out there now. But if we go down this path of a lot of spending and it potentially does create economic growth, well then, with the blue sweep, for example, in the US, like if they come out and spend literally, they're talking about sort of $3 trillion straight off the bat growing to $8 trillion. It's kind of hard to even imagine how much money that is. But this is really significant, and it has the potential to boost interest rates over time as the growth recovers. But we think that's a mid to late decade story. It's certainly not in the next 2 or 3 years that we're going to have to worry about interest rates moving higher.
Our clients with mortgages are going to be happy for a while, but the poor rest of the clients who are hoping for higher term deposit rates might have to wait a while.
Unfortunately, sometime until they go up, I think.
We see one of the clients is pointed out, we see interest rates at higher levels and trying to get people's funds. Obviously, there's you need to look behind that as to why they're offering such a high rate of return. And typically, there's a higher level of risk.
That's right.
Yeah. Just talking about the banks again. One of the questions is around, considering the help that basically the Reserve Bank is providing the banks in having such low rates for them to borrow. Do you still consider, and we've seen a good increase in banks in recent times, in the last month, really. Do you still think that banks are a good investment? And what do you think will happen with the dividend yields going forward?
So if we look at, I can send you some charts on this. I did it at a seminar last year, what happens in zero rate world. But if you look at what happened to European banks and Japanese banks after rates went to zero, it would concern you. So banks basically borrow short-term money, that 0.25 from the Reserve Bank or 1% from the term deposit holders, and then lend it long 30-year mortgage rates. So they're interested in long-term interest rates being higher than short-term interest rates, and they need that positive spread to make money, essentially. So the more that the curve flattens down and that spread contracts, the less opportunity there is for them to make money. And the Reserve Bank's sort of forcing that outcome a little bit at the moment through its policy. So that is a concern, and you can see that is what happened in other parts of the world. Regulation requires that they hold more capital, than they used to. So this makes them safer investments and safer banks. They're less likely to blow up on you. But it also means the return so if they're earning a lower margin on a higher capital base, the return on that capital is falling, and that is the return that is ultimately the profit, which in turn is the dividend. And so as the banks, they're sort of becoming more like utilities. They've cooperated with the government here to essentially make less money, but the government and the central bank sort of stepped in and saved them, helped them fund themselves through a difficult time. And that cooperation means you've got to expect them to earn less over time, because their social license is becoming more and more valuable and more important. They're less independent, if that makes sense. And so we just think they become more regulated, higher capital, lower return. And so I wouldn't expect the dividends to bounce back, put it that way. They've been cut, and that's probably where they're going to be. But similarly, the profit growth that they had is unlikely to return. They sort of they'll be okay because they're going to survive, but they're certainly not going to be the big engine of yield for Australian investors, I don't think, going forward.
Yeah. And I guess that leads into another question a client has asked, is around, particularly in Melbourne, given the lockdown, but also all around Australia, I would imagine, but particularly in Melbourne, what impact will that have, do you think, in the short term and potentially longer term, if any at all, on house prices?
A big question.
They ask the big ones, Tom.
No, it's okay. So low interest rates are obviously very good for house prices. It's really cheap to borrow money, and for a lot of people that can afford to borrow, it's probably cheaper than renting. Like it makes a lot of sense for them to be there and they can borrow more money. I think there's a few things, right? One of the big impacts of COVID from an Australian perspective is we have had a huge reliance on inbound tourism, but also education. And that has, caused a reduction in the expected migration, but also we're closing the national borders. We've relied heavily on immigration for our growth. So lower immigration plus lower student inflows and population means there's less people, which means there's less demand for housing. And we're seeing that pressure rents already. So that's a negative from an investor's perspective. It also appears, if you look at the activity in some of the big regional centres, that people potentially now have worked out they can work from home. And if so, why are they living in a $2 million house in the eastern suburbs of Melbourne when they can live in a pretty nice house in the country mortgage free? And so you may see a bit of an exodus from cities. And also, I think the government's you see policy supporting, we've already seen it, new builds, so bringing on new supply to the market, because that construction is a great activity for stimulating economic growth and activity. And so if you've got lower demand and increased supply and people sort of moving out, it sort of seems like you get this almost flattening of the price curve a little bit, where the quite expensive inner cities, it's hard to see you getting price growth, and maybe in some areas, once people actually have to start repaying, there's a lot of mortgage holidays, right? And a lot of dual income households that maybe, one of the professionals is not getting a bonus this year or has had their hours pared back. And so I'd like to see that wash through the system a little bit in the next 12 months before knowing we also don't know, particularly in Melbourne, what the clearing price will be when we actually get proper sort of supply and demand coming through once the market reopens here. So I'd sort of say inner city may have a little bit under pressure because it's linked to rents and lower activity from immigration. Regions might do quite well. So, if you've got a holiday house as well, maybe you're going to pick it up on the other side.
Well, we're coming up to an hour, and I'm looking here, and all of our clients have held on. So I really appreciate and hope you found some value here, Tom. I might just finish with one last question from a client. Sure. We'll try and keep this to a short response because it's quite a big question. But will the lack of potential trade, both locally and internationally, with China have any impact on the planning of projections and where we potentially invest? Do you see that playing a big part in your decision-making process?
Yeah, we're pretty global in terms of our asset allocation. In the review this year, our long-term expected return from Aussie equities is sort of slightly below global. So we do favour global. Australian equities are only really 2% of the global market. So it is important to think globally. Also, these portfolios are designed for an investor that's trying to diversify away. And if you own a house in Australia and other assets, like, you should be thinking globally in terms of diversifying your total balance sheet. In terms of China, specifically on the trade, I think it's another headwind for Australia. We've got obviously the education headwind, the tourism headwind, and now we've got our biggest trading partner trying to have some sort of trade war with us. So that's clear negative. And so can potentially weigh on growth. In the very short term, I think Australia is going to look good this summer. As we reopen, it's going to look and feel quite good, and that might provide some support for the market. However, some of those more structural headwinds are sort of yet to play through, and we still prefer global growth over domestic growth for those reasons.
Yeah. Well, that was a really thorough look into how things are going, where the portfolio is positioned, and a bit of a look into the future, which is obviously more volatile than it ever has been, as you mentioned, Tom. But we really appreciate you coming on, and I'll be interested to get some feedback from all our clients. We hope that you found that informative.
A pleasure.
I'd like to invite you back again, if that's okay, maybe in the next couple of months. I'd like to perhaps have a discussion around when we hopefully have an outcome with the US election. And then as a result of that, how you have then viewed that, and then how you potentially set up the portfolios as a result.
That'd be great.
Yeah,
we will have more information at the time, and I think everyone can see the sort of topics we cover. If there's anything specific that anyone would like us to cover, then let Brendan and the team know prior, and we can put in a slide, and we'll make it a topic that we're happy to discuss anything that's of interest. So thanks for having me along.
Well, thanks, Tom, and to
Pleasure.
our clients, really appreciate it. I can see that you've all hung on for it, so hopefully it kept you informed, and we'll be in touch soon, as we always are. So till then, take care, everyone, and we'll be talking again soon. Bye for now.
Thank you.